All right, welcome everyone to today's Title Topics webinar. This is Alta's free presentation that we've been offering every month to discuss important issues impacting title professionals. I am Jeremy Yowie, Alta's Director of Communications, and today we have some great speakers from the National Association of Realtors who are going to provide some great insight into homebuyer and seller trends as well as a forecast of the real estate market for 2014. Before starting, we just need to touch on a few housekeeping items. Links to download copies of today's presentation were emailed earlier today to all registrants. If you didn't receive it, please shoot me an email at jyowie@alta.org. Again, that is jyowie@alta.org, and I will send you the material after the conclusion of today's webinar. All participant lines are muted. If at any time you have a question, please use the chat box function, and we'll hold some time for Q&A at the end of the webinar. As an added benefit, the presentation is being recorded. After it's processed, the recording will be available at alta.org/title topics, and again, that is alta.org/title topics. I need to thank SoftPro for once again sponsoring our Title Topics webinars. Their support allows us to continue providing these educational opportunities free of charge. With that out of the way, let me introduce today's speakers. First, we have Jessica Lautz, who is NAR's Director of Member and Consumer Survey Research. Jessica analyzes data and writes annual studies for NAR's member profile, the profile of home buyers and sellers, and the commercial member profile. We also have Ken Fears today, who is NAR's Director of Housing and Finance and Regional Economics. Ken focuses on regional and local market trends and also writes on developments in the mortgage industry and foreclosures. Thank you both for joining us today. Now, while a lot of attention over the past couple months has been devoted to a lot of the regulatory changes impacting the lending industry, it's also vital for title professionals to keep a pulse on what's going on in the real estate market. And we have a lot to cover in today's market. So with that, Jessica, I'll hand the webinar over to you to dig into the home buyer and seller trends.
Great. Thank you so much. I'm going to be going over the profile of home buyers and sellers, and this is a report that we do on an annual basis. And some of this data you might actually be familiar with, such as tenure in home, thinking that someone moves every 7 years, the use of the internet, and those are all data points that are pulled from this report that are pretty commonly used. The methodology is we collect the data in the summer. It's looking backwards at the exact year, so right at that point, so July to June, and we try and get this report out every year in November so that it's the most accurate and up-to-date data that we can possibly get on who the recent home buyers and home sellers are in the market. Jumping right into the data, because there's quite a bit here that I want to cover in a pretty quick amount of time. The trends that we've seen with the tightened mortgage and lending conditions in the country have definitely influenced who our buyers are. So right now we're seeing the median age is a little older than what we've seen in past years. The income is higher, and we're seeing a higher share of married couples, thinking that they have dual incomes as opposed to those single females and single males who may not have as much income as that married couple would. We're also seeing the last data point, the last line down there, the share who own a second home is actually higher than what we had seen when we look from 2010 and years prior to that. Also an indication of perhaps higher income, taking that into account. So when we look at the shift in household composition, it's really interesting to see this on a graph. When we go back to 2001 to 2013, we can really see the shift from 2010 on, and that share of married couples that rose, and then at the same time, the share of single buyers who fell. So that would be the 20% climbing down to 16% among single females, and that 12 declining to 9 among single males. Those single females are still second only to that married couple, and that's been a popular storyline. But I think it is important to see that that is affecting the share of them overall in the market. We're also seeing that the first-time buyer share has remained suppressed. This has also been a popular storyline in the market as well. but we can see that the share right now is 38%. When we look back all the way back until the 1980s, the historical norm is about 40%. So we're seeing a little bit of suppression here. Now, while that 38 to 40 is a very small percent share, it actually accounts for a large number of buyers, potential buyers who could be in the market right now. One of the new questions that we added this year, because we're seeing different types of households in the market with this tightened credit conditions and perhaps doubling up due to job conditions and perhaps those teenagers not being able to find jobs once they get out of college, we're seeing multi-generational households forming. 14% of recent home buyers actually purchased a multi-generational home. So not one that they're just going to live in with them, their two kids, and their kids are going to go off to college and they're not going to see them again. That's not necessarily true anymore. The reasons why they're purchasing is for those kids who are over 18 moving back in, but also for cost savings and taking care of aging parents, and also spending more time with those parents. So there's a little bit of shift here going on in what your traditional household now looks like. When we look at those first-time buyers, we created some vignettes, some breakouts that really look at who these different types of buyers are. And you can download these PowerPoints for free online. And I'll provide that website link at the end. But you can see their income's a little bit lower. Their age is typically 31, so perhaps just starting out in their career. And they're typically buying a single-family home, but a little bit smaller than what we'll see for the repeat buyers. The typical repeat buyer is buying a home that's over 2,000 square feet compared to those first-time buyers buying a home that's just over 1,600 square feet. And their income among our repeat buyers much higher. We've also seen in recent years there's a suppressed level of new homes on the market. A lot of that is due to the lack of new construction, also due to lending conditions. And we can see that just 16% of homes that were purchased in the last year are new homes. We asked a series of questions on the reasons why they were purchasing a new home versus a previously owned home, and lack of inventory definitely hits the list on why they could not purchase a new home. But you can also see that there are also reasons behind purchasing previously owned or a new home: to avoid renovations on the new home, choosing customized features, but for a previously owned home, perhaps a better price, better overall value. We ask a laundry list of questions about the location where you purchased a home. The quality of the neighborhood is always number one, as well as convenience to job, the overall affordability of home. Obviously, these three factors mean quite a bit of different things to different people. So the quality of the neighborhood to me could mean a completely different thing to Jeremy or perhaps Ken, as well as convenience to job. When we break this out by different household types, so that single female versus single male versus married couple, these of course change quite a bit. So those homes that have kids in them, they're obviously thinking more about that school district, the distance to the school and the quality of the school. Our single female buyers perhaps thinking more about their convenience to friends and family, whereas single males are thinking more about their convenience to entertainment, walkability of a neighborhood. We've asked a series of questions for the last few years on commuting costs and energy efficiency, commuting costs being very important to buyers. But when we looked at environmental features as well, you can see that the heating and cooling costs, energy efficient appliances, lighting, these are all things that directly affect that buyer's pocketbook at the end of the month. So things that they're going to be writing checks for, things that they're going to have to replace in the future are counting more to them, or more important to those buyers than perhaps those community features in the neighborhood. We do see that buyers are making compromises right now, and part of this is due to the tightened inventory on the market. Our first-time home buyers are more often making compromises, that's the bottom line, and our repeat buyers are making less compromises, perhaps because of their buying power, having more equity from a past home, being more experienced in the home buying market, so they're making less compromises. A few years ago, we started asking questions on our seniors who are buying in senior housing or active adult community. Now, these could mean two very different things. I do cut this number by those. You can't hear me? Jeremy, can you still hear me?
Hey, Jessica, yeah, we can hear you fine.
Okay, great. Thank you. Okay, so we started asking questions about the senior housing or active adult community. I cut these numbers above our seniors who are over 50 years old. So that's a pretty young age. So these guys could be living in a golfing community, could still be very active, could actually still be working. But they also could be those seniors who are living more in a retirement community, definitely in full retirement. We are seeing that the share who are purchasing in active adult communities are growing. So when we looked at this in 2010, we're thinking about 10, 11%, and today we're looking more around 14%. So I think that this share is only going to continue to increase in the future as our baby boomers start retiring as well. Perhaps moving closer to friends and family, retirement, want to be in a community that provides more amenities to them. One of the big changes that we've seen in past years, and I alluded to this when I started, was that the tenure in home has increased. So this is the expected tenure in home. Expected tenure in home is always a little bit longer than the actual tenure in home. Once you move in and unpack those boxes, you really have no intention of ever moving again. So you can see the yellow line is our repeat buyers, and the gray line are our first-time home buyers. The yellow, we're looking at 15 years is the expected tenure in home, and first-time buyers is now 10. So this is much higher than what we had seen in past years. Another part of the expected tenure in home rising could also be due to locking in those low interest rates. So once this buyer has locked that in, around 3%, 4%, they really don't want to move again in the future. Now, among our sellers, our actual sellers, you can see that the actual tenure in home is a little bit less at 9 years currently. Part of this tenure in home increasing from 6 to 7 to 9 is partly due to those underwater current homeowners, so those who were not able to actually sell their home. And we do ask a question about this in our report as well. So we ask a series of questions on the search process, and we can see that online websites are the most popular for searching for a home, as well as your real estate agent and mobile. Mobile has increased substantially. We can see the value of different website features. Photos, of course, very important, detailed information, virtual video tours, interactive maps, things that you can really put yourself inside of that home. When we look at mobile search, among our mobile searchers, 22% actually found the home that they ended up purchasing via a mobile application. So that's a pretty impressive number and something that is only going to be increasing. 45% of all buyers did use a mobile search device. We ask a question about different communication types, and this is important, I think, for all real estate professionals to really think about, not only the real estate agent, but also brokers, mortgage brokers, and anyone really involved in the process. They really, our recent buyers, really want someone who's going to call them, think about property listings, sending them emails, market reports. And I think it's important to keep in mind, as anyone in the real estate industry, just as us as consumers are out there looking, perhaps using the Amazon app as we are in the grocery store or scanning something to see if we can get a lower price somewhere else, that the housing market is the same. So we're going to be looking at our mobile apps, showing mom and dad, showing our friends, hey, this is a great house. I think I want to live there. Some of the changes that we've seen in the market with heightened inventory, our buyers are looking at fewer homes before buying. They're typically only looking 12 weeks and 2 weeks before contacting the agent. So it's a pretty quick process before actually putting a contract down on a home. More than half of buyers reported the hardest task was just finding the right home. So not the lending process, not the paperwork, it was just finding that perfect home for them. On the selling side, we're seeing that sellers are typically receiving a higher percentage of the final asking price, and the median time on market on a national scale dropped to just 5 weeks from 11 weeks, and that was just in 1 year's time period. We see that the agent use remains high, and I was actually a little bit surprised that it is remaining as high as it is. I think that the process is very difficult right now for buyers. Heightened inventory, you want an agent who really has a pulse on the market and can get you into a home that perhaps is not listed yet. Perhaps they know that the home is coming on the market quickly, and they need help during that paperwork process and during the difficulty of understanding. When we look at the FSBO share, it is really low, historically low. Just 9% of our recent sellers sold via FSBO, so for sale by owner. When we look back to 1991, it was nearly 20%. When we looked at the FSBO sellers, 40% actually knew the buyers, so it's just an arm's length transaction, and they didn't typically need to sell urgently. Some of the hot topics that we added to the survey this year were things like expenses that delayed the down payment. So this is just among that 12% who had a hard time saving for a down payment or saving for a home purchase. So it's a pretty small share that we're pulling this out of. But when we looked at the type of loans that are holding them back, among first-time home buyers, not surprisingly, student loans were holding them back from purchasing or saving from a home. And then among repeat buyers, credit card debt. We also asked recent buyers if they had previously sold a distressed home. 6% had, and the typical year that they had sold that distressed property, so a short sale or foreclosure, was 2009. So they're getting right back out there in the market. I had alluded to this chart earlier, but these are among sellers who wanted to sell earlier but had to stall or wait because their home was worth less than their mortgage, so they were underwater. Those who purchased between 6 years ago and 10 years ago, they are most likely to fall into this category. About 20% of them did fall into this category, and they lived in their home. This is a free PowerPoint that you can download, so if you're looking at your particular subregion and you want more information, we cut it by all of these different subregions. And just to give you a quick overview of what's included, we just have, these are 2 comparison slides. I'm just going to point out a couple of figures here. The household income, $88,000 in New England, typical age of a home buyer, 38, and 11% bought a multi-generational home. When you look at the mountain region, income, vast difference. 73,000, age 48, much higher, and 19% bought a multi-generational home. So there's some pretty big differences among sub-regions. So if you're interested in that, this might be a good thing to download. And there I am. So Ken's going to take it from here, talking about future outlook.
All right. Ken, you should be getting a notice that you have control of the presentation.
Yep. Yeah, I have it. Great, thank you. As was mentioned, my name is Ken Fears. I'm an economist with NAR. And I'm going to be walking you through kind of our expectations for 2014, what we, some of the road bumps that we see ahead, and how we see the market moving around them and forward, and kind of our progress report and expectations for 2014 and moving into 15. So 2014 will be the year of Sinkerswan. We've been talking about several major regulations and regulatory changes for about 4 or 5 years now, tied up in Basel III and Dodd-Frank, of course, and some of the implications from them. And finally, these will be implemented. So it'll be go time. We'll figure out, you know, for better or worse, we'll have that consternation behind us, and we'll actually be dealing with the mechanics of it, what it means to the market. And then secondly, nearly all of the stimulus from the market will be eliminated when the Fed ended its purchases of mortgage-backed securities and treasuries near the middle of 2014. But at the end of the day, underpinning all this is a very, very tightly tight inventory situations, and that's what's really driving the picture is the inventory. So home sales have been doing very well over the last 2 years, relatively speaking. But what most people don't realize is that home sales were rising rapidly in advance of the third installment of quantitative easing. So the trend was already in place, and that was really being driven by steady improvements in employment conditions, but also mortgage rates that were low, driven by underlying weak economic conditions, at least in the mortgage market. Now, these strong home sales have steadily whittled down inventory levels. I'm sorry, I just saw that my slides are not showing. So here's the original slide of home sales volume. Again, the green section on the right-hand side is represents the period of quantitative easing, the third period of quantitative easing. And again, what I was alluding to is that in advance of that, we saw a steady increase in sales, despite the fact that the Fed was not doing the purchases during that period. But again, home sales have been very strong, averaging about 5.1 million on an annualized basis. And this has reduced inventory significantly here, represented in the blue bars. More importantly, what we've seen is a steady reduction in the month supply of housing, which is simply put the ratio of supply to demand. And when that ratio goes in about 6.5, which is the neutral level, we begin to see rising prices. And that's exactly what we've seen for about the last year and a half, steady growth in prices on a year-over-year basis. And this has really helped improve the fundamentals for the market. Now, of course, affordability has fallen because of the recent increases in mortgage rates as well as the rising prices, and that's had an impact. But what's important to note is that the shoe has not dropped. The home sales, or at least pending home sales, remain robust right around the 5 million range. And even if they eased, it's important to note that inventories are still very tight, so that all-important ratio of month supply will remain low, or at a worst case scenario, neutral, suggesting strong price growth going forward. So shifting to fundamental drivers of the market. On the demand side, looking at the employment picture, we had a really mixed picture or indicator come out on Friday, with the unemployment rate falling to 6.7% from about 7%. But really, this was driven by nearly 400,000 people leaving the labor force, which is not a good sign. And this really speaks to the labor utilization rate, which has been a recognized problem for a while now. There are roughly 6 to 8 million people who have not re-entered or been pushed out of the labor force during and after the Great Recession. So this is a problem lingering out there that the unemployment rate really isn't taking into account. Having said that, job gains, job creations have been very strong in the last 5 months. Really, in November was where we saw the first significant uptick and a subsequent revision in that month to the October and September numbers. So we saw a surprise there, and mortgage rates increased as a result. More recently, in December, just last Friday, we saw a surprise of only 76,000 job creations for the month, well below expectations of 200,000, nearly the lowest monthly level of job creations in about 2 years. But the rising rates are definitely having an impact. On the right-hand side, the large bars, that's the affordability number, and what we see is that affordability has come down significantly since the beginning of this year. But if you note the level, and we just draw it across there in that pink bar on the left-hand side, what that suggests is that even at the higher rates and the substantial increase in prices, about 10% for 2013, affordability is much stronger than what we had over the last decade. And if you continued that line back to the 1990s, it's stronger than that period as well. Consumer confidence is on the rise, weak relative to the prior decade, but again, on the rise. Consumer confidence doesn't always move in lockstep with buyer confidence, and buyer confidence has been very strong and very wary of those rising rates and wanting to get ahead of that. So, but consumer confidence is important because at the end of the day, consumer spending and employment is driven by that portion of the market. So we've taken a hit recently, but it's definitely trending upward and likely to improve in the spring. On the supply side, a number of important factors that are shrinking the flow of supply and keeping a cap on inventories. We've seen the shadow inventory decline as 30, 60, 90 early stage delinquencies have been on the decline. However, we still do have large reserves of REOs and foreclosures, particularly in the judicial states. By contrast, Florida has a foreclosure inventory of about 10% compared to California, which is about 1.3%. So there's foreclosed, those REO inventory are not moving as quickly and kind of artificially inflating this number. But as the market continues to tighten, a lot of these will get moved through the system. Now, probably the most important figure, I think, in at least in 2013, is the strong improvement in underwater borrowers. And the reason for this is there's a strong correlation between foreclosure and a double trigger situation where someone's underwater and they have a life event. So they have a loss of a job or a reduced income, or they become ill or some other event like that, and they roll into foreclosure. Well, with that number having been slashed nearly in half, what it means is that there are significantly lower or less likely for these people to roll into foreclosure. So that's another channel for new inventory that's really being shut down. And then finally, construction, though it's up in the most recent reading, is historically relatively weak at 727,000 units. We have another reading on Friday, so we'll be eagerly anticipating that. Now, back to the demand side, household formation is definitely on the mend. It was hovering about 600,000 for the prior 5 years. It jumped up to just under a million in 2012, but it's below the historic average of about 1.15 million. So there's still improvement to be made there. And it is likely that the 2012 number will be revised and the 2013 number won't quite be what the 2012 number was initially, but still a strong improvement. And if we do continue to add on this household formation, it'll just, again, continue to erode or stimulate demand and erode those inventory numbers. But underpinning all this is very tight credit conditions. And the average purchase applications at FHA and at the GSEs remain about 30 to 40 basis points, or 30 to 40 points higher than they were back in the 2001 period or the late 1990s prior to the relaxation of credit standards during the boom period. Shifting to the capital markets, because really this is where the inventory story as well as the regulatory and the stimulus stories are kind of flowing from. The recent increase in rates in November has certainly had an impact. And once again, they're tracking, more closely tracking the long-term treasuries as the primary, secondary spread has come down. But it does beg the question, as we continue to layer on this stimulus and we don't get the same reduction in rates, how effective it is and whether it's worth continuing. And that's what we see with the yellow arrow on the right-hand side, is that as the blue bar, which is the total purchase of MBS, rises, we're seeing this sharp rise in rates there in red. And you just got to wonder, despite the increase or the weak increase in employment in December, how much incentive really is there to keep those purchases going and not to accelerate that taper. On the upside, one thing that will help to ameliorate the rise in rates going forward is an increase in competition among originators on the purchase side. For the last 2 years, originators have been able to rely on income from refinances and larger margins, and now they're going to be more focused on that purchase originations as the refi volume falls significantly. So we're expecting both a reduction in margins, which will help ameliorate some of the upward movement in prices, but also a tighter focus on potentially expanding the credit box. So this should help, particularly as we move further away from the implementation of the qualified mortgage rule. One thing boding well for the market, which you've probably already read about in the newspaper, is the decline in the spread between the conforming and jumbo markets. Traditionally, it's been about 20 basis points. It's actually come down to parity, and for a few weeks here and there, it's actually been cheaper to borrow money in the jumbo space than in the conventional space. And this has helped, of course, expand the private lending, particularly the private portfolio lending. PLS seems to be hampered by a number of kind of fundamental institutional factors, including a need for a more standardized rep warranty framework and servicing frameworks that really have not been hammered out yet. But it's important to note that the improvement that we've seen in the conforming jumbo spread has really been driven by increases in rates in the conventional space rather than decline in rates in the jumbo space, as the G fees have increased, nearly tripling over the last 3 years. In an attempt to expand that private space, the FHA as well as the FHFA have proposed reducing the loan limits. And here what we see graphed is a chart showing the change in the loan limits down to the county level. And what you see is with the FHA, the proposals for 2014 are significantly lower limits on both the east and west coast, but also a number of markets in the central United States. Likewise, with the GSEs, there's a proposal to reduce the limits down to 400,000 from 417. In a normal, healthy market, this would make sense, as it would likely just push a lot of the volume into the private space, or at least into the jumbo and PLS space rather than the conventional space with MI, where we've seen a healthy movement to MI away from FHA. The problem right now is that the jumbo space, or in the non-conventional space, is very tight. We're seeing significant overlays in terms of higher down payment requirements, higher FICO requirements, significantly higher reserve requirements, and as I pointed to earlier, with the conforming jumbo spread at parity, or actually lower in the jumbo market, if you could qualify for these rates, you likely already would have migrated. So by reducing the loan limits at this time, you're likely not pushing those borrowers into the private space. You're likely pushing them out of the market altogether. So the one thing that is certain in the spring market is a lot of fundamental changes. The qualified mortgage rule, of course, was implemented last Friday, and it's likely that we'll see a few bumps in the short term on higher pricing or complete no credit availability for some borrowers. In the longer term, it's likely that we'll have this smooth out to an extent, but there will be a portion of the market that likely won't have access. We've got lingering questions about whether, what form the qualified residential mortgage will come out. A few things to finalize with respect to Basel III and reference warranties risk still linger, particularly with a number of lawsuits that are still out there. Although we've seen two major ones settle now with JP Morgan and Wells Fargo. I believe Bank of America close behind, which will help, again, with these guys moving into the new regulatory environment. And then finally, the big question behind all this is, will the Fed be able to exit in a stable manner, and what that means for the simultaneous introduction of these regulations. However, to the CFPB's credit, I'd point out that they did try to expand the market that would have qualified for the QM standard, so that only a very small portion, by our estimate 6 to 8% of the market, would not qualify as a qualified mortgage. And they also included a patch so that any mortgage that would clear underwriting, and automated underwriting to the GSEs or FHA that had a back-end debt-to-income ratio over 43% would get the QM label. The problem is that goes away in 7 years, so we only have 7 years to figure out just how important that back-end debt-to-income ratio is. That's assuming that we don't get a GSE reform prior to that. If they come out of their current status, then those loans would lose the QM status. We could have a significantly larger portion of the market exposed to the non-QM status. So anywhere from 15 to 24% of the market could actually get exposed to that non-QM status and higher rates. And it's important to note here, too, that it's not just first-time buyers who have the high back-end debt-to-income ratio. In the conventional space, there are an equally large portion of the distribution of repeat buyers who are above that 43% back-end debt-to-income ratio. Now, one concern that largely looks to be avoided is the potential for another government shutdown, as it looks like we'll reach an agreement by Friday on an omnibus spending bill. And then the GOP is also putting a lot of pressure on its party members not to create the same kind of situation or foment the same kind of situation that we had with the run-up to the debt ceiling crisis in November. So what is likely to happen in November is that there will be measures taken to avoid such a situation. Now, looking through our expectations for 2014 and beyond, we expect GDP growth to improve, but really muddle along under the historic average of 3%, only hitting that by about 2015. Now what that means is steady growth in employment, but it will be weak and it will only make a small improvement in eliminating that very large reserve of unemployed workers that we have out there. However, the relatively tepid growth in GDP will help to mitigate the upward movement in rates as the Fed pulls out. So for the year, we're only expecting an average 30-year fixed rate of about 5% for 2014, up to about 5.6 in 2015. But again, a lot of the increase in rates will be on the back end of 2014. So right now we're hovering about 4.5%. We'll likely see a higher rate by the middle of the year, with some increases really driven by growth in the second half of 2015. Excuse me, in the second half of 2014. And then what this means for sales, though, is really a market that will move sideways. Our estimate for 2014 is about 5.1 million units. That's roughly the same as last year. But it's important to note that the number for last year was upwardly revised from our initial estimates of 4.75 million units. So it's a strong year in 2013. And even if we move sideways at the same level without significant increases in inventories, it means that again, the critical month supply ratio will likely remain contained, and thus we'll continue to see price appreciation in 2014 and 2015. Though not as strong as 2013, not the heady 10 to 13%, we're likely to move closer to the historical norm of 3 to 5%. And again, that's very important for affordability, as income growth needs to catch up with the price appreciation and rate appreciation that we've seen over the last 2 years. So 2014 will be the year of sink or swim for the market. We have a number of regulatory changes, probably the biggest of which has already been implemented as of last Friday with the qualified mortgage rule. A number of important factors that will help to ameliorate that impact that were kind of brought in at the regulatory level. And then again, we have the overarching issue of how well or how effective the Fed will be at pulling or moving its stimulus without disrupting the market with a sharp increase in rates. And then finally, underpinning all this is a very tight inventory conditions. And so with that backstop, it's very unlikely that, although we will see some disruption certainly on the demand side, with these very tight inventory levels, it's likely that we'll have in terms of the ratio, it will be very contained, and thus pretty steady, stable upward pressure on prices through 2014 and 2015. Continuing on the improvements that we've seen in the shadow inventory reductions, as well as the lower delinquency and default rates moving into 2014 and 15. So with that, I've completed my presentation. Now I think we have some time for questions.
Thank you, Ken. A lot to digest there. A lot of moving parts impacting the market over the next year. As a reminder, if there are any questions from the attendees, please submit them via the chat box or the questions box. We're monitoring both of them. Ken, as we wait for any questions to come in from the attendees, you talked about the qualified mortgage rule, also known as the ability to repay rules. Has NAR done an analysis on how much impact that's going to have on mortgage rates and possibly transaction volume?
Yes, we actually have a survey of affiliated lenders and some non-affiliated lenders actually in the field right now, and so we hope to better capture what their not just our estimates, but what they're actually going to be implementing. And we're anticipating a number of effects. First of all, only about 8% of the market would not qualify as a qualified mortgage. However, there are two statuses of qualified mortgages. You've got the rebuttable presumption, and then you've got the safe harbor. And the safe harbor provides the maximum legal protections. So these loans are very likely to be made, and the new rules will have very little effect on it. Within the rebuttable presumption, though, there are a significant number of lenders that are indicating that they may not originate these loans, or that they may originate them with buffers in place, buffers in advance of, say, the 3% cap on fees or the 43% back-end debt to income, regardless of whether it's automated. It goes to the automated underwriting of the GSEs, or putting in place a cap inside of the 150 basis points over average prime offer rate for the pricing. So there's that, and then once you get out into the truly non-QM space, again, only estimating about 8 to 10% of the market, we're expecting that once the market stabilizes, excuse me, a year to 2 years down the road, that may only be about 5 to 15 basis points higher, depending on how pristine the loans are. As most of these will be done in portfolio, so you will have very specialized lenders that might venture into the space, where you're talking about subprime non-QM loans. In the near term, though, we could see higher costs. Again, as these will be highly specialized lenders holding them in portfolio. You could see costs of increases of 15 to 50 basis points. And some of the anecdotes that we're hearing from lenders is just that they're talking about layering these on. So again, there'd be two effects there. One, some lenders won't do these loans, particularly in the rebuttable presumption space, but also in the non-QM space. And then there'll be higher costs in the truly non-QM space, as well as buffers in advance of the restrictions within the QM.
Okay, thanks, Ken. I guess with the rule going into effect last week, we will have to see in the coming months. Jessica, have a question about maybe trends among real estate brokerage firms. Howard Hanna, it was in the news, recently acquired a competitor and expanded into the Virginia and North Carolina market. Does NAR expect to see more consolidation among brokerages over the next year, or can you offer any color in this area?
Sure, absolutely. So we recently did a report called the 2013 Profile of Real Estate Firms, and we asked a few questions on mergers and acquisitions, and we actually found that 9% of firms feel that mergers have increased in the last few years, so 2013 to 2008, in comparison to 07 to 02, and just 5% considered that they thought that it had decreased. We also asked franchised firms if they had merged with another firm or changed franchise affiliation, and we found that 5% had. There's an entire chapter devoted to what the firm's expectations are in the coming years, looking forward. And so we asked this over the summer. There's a lot of firms that are recruiting, 45% are, and when you look at larger firms, they're more likely to recruit new agents. And we also looked at what their pressures are that they could see in the market, so whether that's non-traditional real estate firms, or local economic conditions. So there's a lot of juicy information in there that might be helpful to download that report as well, and that's free on our website.
All right. Thank you, Jessica. Interesting perspective on what are on the minds of real estate companies as far as growing. Ken, have a follow-up question from Cynthia on the qualified mortgages. She was hoping you could maybe explain why some lenders may not offer qualifying mortgages, and is it possibly due to the restrictions on costs?
Yes, exactly. So within the qualified mortgage rule, you've got two different degrees of legal safety. You've got the safe harbor, and you've got the rebuttable presumption. And particularly for a lot of smaller lenders who don't have the legal access and kind of the deep resources there, having a couple of these bad loans originated and then facing those legal costs could seriously not just crimp production, but you would have reputational risk as well. And thus, if your business model is to originate for conduit, then you're going to start to have problems finding conduits who are willing to take your production. So these, for even with originating within the QM space, there are, consequences for not producing exactly, what the statute would be, and incentives for actually producing well within them. Just again for a safety margin on top of what's required.
Okay. All right. Thank you, Ken. Well, we've totally blown our deadline of 30 minutes today, but we had a lot of a lot of information to talk about, and so I think it's time wisely used. Just as a reminder, if you missed parts of today's webinar or think others in your office would benefit from listening, a recording of the presentation will be available for replay early next week at alta.org/title topics. Looking ahead, our next webinar in February will focus on how Alta members can utilize social media to market their business, and we'll also share some tools that Alta provides to help in this area. So be on the lookout for registration information for this webinar. Jessica and Ken, thank you both for taking time and giving us a little peek into what's going on in the housing market. And with that, sorry, thank you.
Thank you.
Thank you.
And with that will bring us to the conclusion of today's presentation. I hope all the listeners found everything useful. Take care, everyone.